The Dow has had 13 straight up days. The last time the Dow had 13 straight up days, you know when it was? 1987. What happened in 1987? The stock market crashed. Now, I don't want anyone out there to say, oh, Gareth's predicting a crash. I'm not necessarily predicting a crash. What I am saying to you is this is a time when you see everything going up and you want to FOMO into the market, when you want to be like Bitcoin and be like the individual you probably were at 68, 69,000, sometimes this is a time to sit back and be patient. Because again, instead of buying at 68, 69,000 on Bitcoin, a lot better to buy right now at 29, even if it goes down, much better than 69,000.
The European Central Bank raised interest rates for the 9th consecutive time on Thursday. The possibility of a pause in September as inflation pressures show tentative signs of easing and recession worries mount. Fighting off a historic surge in prices, the ECB has now lifted borrowing costs by a combined 425 basis points since last July, worried that price growth could be perpetuated by both rising costs and wages in an exceptionally tight jobs market. With Thursday's 25 basis point move, the ECB deposit rate stands at 3.75%, its highest level since 2000, before euro notes and coins were even in circulation. The main refinancing rate was set at 4.25%. ECB President Christine Lagarde ditched her practice of guiding markets for the next decision and said what would come next was in the balance, even if the central bank was determined to break the back of inflation. Gareth Soloway shares his insights regarding interest rates, inflation, the stock market, and cryptocurrencies. Sit back and listen as Gareth shares his view. Also remember to like this video, subscribe, and drop your comments below.
Yesterday, Fed raises by 25 basis points. 25 basis points totally expected. What we weren't expecting was a more dovish tone. For instance, Jerome Powell said, and this is something where I saw the dollar decline instantly when he said this, he said, we realize as the Federal Reserve that there's a lag in monetary policy, meaning that they're raising and they've continued to raise, but there's a 6 to 12 month lag before it hits the economy. All right, so right off the bat, that's important to understand. All right, so they're saying that, which means they're going to be more hesitant. It's a hesitation in further rate hikes. Now, if we see inflation start to uptick, they may have to go back to hiking. But right now, to me, that tells me there's a wait and see attitude. ECB this morning raises 25 basis points, says the same thing as the Fed, says they're data dependent. Okay, so a couple things to go over here. This morning, we got GDP numbers, 2.4%. Better than expected. This economy, folks, while you do have certain economic factors that are weak, the main headline numbers, jobs, as well as GDP, very, very strong. The consumer, while growing more and more in debt, is still spending money hand over fist. Credit card debt now north of $1 trillion, the highest of all time. The amount of money that people are spending on housing alone is at an all-time high. It's at 40%. 40% of income being spent on housing, yet the consumer is saying, you know what? We are just going to continue to spend money, probably partly due to the stock market going up, makes them feel richer, and partly due to the fact that we've become children. Everything's about bailing us out. The Fed will bail us out. The government will send us checks. No big deal. Let's just spend, spend, spend. After COVID, we had this urge to just spend very hard. Once you start spending money and living a little bit freer, we know it's very hard to cut back to where you were prior. All right, a couple other things. So GDP coming in better than expectations at 2.4%. Expectations were 2%. Durable goods orders coming at 4.7% this morning. That was better than expected as well. However, this is the kicker. What wasn't better than expected, if you take out transportation from durable goods, guess what? It was lower than expected at just 0.6%. So again, this is where it is, right? This is what kind of market we're in. We're in a market that's euphoric. We're in a market that wants to continue up, that people had money on the sidelines. They want to chase things like stocks in like Nvidia, or in this case, Meta today after the earnings from Meta. I'll talk about that in a minute. But then we do have underlying economic data that's a little bit weaker, a little bit weaker. Now, one number that wasn't weaker was jobless claims today. About 6 weeks ago, we saw jobless claims spike to about 260,000 or so for 3 weeks in a row. We've come right back into 220,000. Today's number, 221, lower by 7,000 jobs from previous week or the previous week. And again, folks, what that tells us is there's not a lot of firing. There's not a lot of people filing for unemployment. And that's what that number is, folks. The initial claims are how many people are claiming unemployment. And so the reason why you pay attention to this is if that starts to spike, and usually the kicker is this, I'll tell you what to watch for. Watch for 300,000. If we get above 300,000, that's major trouble for the economy. As long as we're below 300, it's not that bad. It's not that bad at all.
While overall inflation is halved from October, underlying price growth is hovering near historic highs and may have even accelerated this month. Lagarde said the risks of so-called second-round effects had not worsened since last month. But record low unemployment has raised fears that wages will jump as workers seek to recoup real incomes lost to inflation, which is why many investors and analysts have been expecting the ECB to hike again in September pending autumn wage data. Gareth further explores the cryptocurrency market, making analyses on Bitcoin and Ether and forecasting interesting price predictions. Let us now get back into the video.
The fact that we're seeing inflation, meaning food and energy, spiking higher, and remember, yesterday in the stream I showed you guys the chart of gasoline at 52-week highs. Oil not that far away from 52-week highs. Month over month, both are up 15+%. So month over month inflation jumping substantially. Year over year is almost flat now. If we also looked at the DBA, which is the agriculture ETF. It's at 52-week highs, up big this month. So again, by the way, look at orange juice. Orange juice skyrocketing as well. Not that that's a big one, but I think it's just another commodity that is going parabolic. These are going to have an impact. And if we're saying now, and the Fed has said yesterday, this was big, the Fed's people said no recession. No recession. And if that's the case, and we're going to start to reaccelerate in the economy, then you have to expect inflation to reaccelerate because demand for commodities is going to rise, as well as if people are doing better, demand for all products are going to rise. So everyone was so happy about the consumer price index last month. Get ready, guys. It's going to start upticking. And the key is going to be is if it upticks, how does the Fed react? Do they have to go back to raising rates? Do they say, hey, we aren't going to cut till 2025, which is kind of what they're saying right now. And by the way, yesterday Jerome Powell said that. He said, don't expect us to cut till 2025. That's a lot of time where rates remain very, very high. But remember, after yesterday, we're at a 22-year high on interest rates, 22 years. We have Bitcoin still trading below the range. As long as Bitcoin's below the range, it is vulnerable to a drop. Okay, so again, yes, it's had a couple up days, but remember, these couple up days are coming on the back of the Fed saying what they're saying here and all these other things. So again, the fact that we're not back above 29.9 to 30,000 is a little problematic. Doesn't mean it can't happen, but again, that's a little bit problematic. Watch again, are we creating a bear flag here that could divulge into a bigger move down? Going back to over here, I want to show you the Ethereum chart. Okay, so let's go to the Ethereum chart real quick. The Ethereum chart is remaining in this channel, downside vulnerable to this level. This would be the equivalent of that 27,000 level hit on Bitcoin. So if we get down to about 1770 or so, that's your support. That's the level you want to hold on Ethereum. If it breaks below that, trouble brewing. As long as it stays at or above that level, honestly, just like Bitcoin, Bitcoin stays at 27 or above, it's okay. Not that big of a deal.
Markets had fully priced in another rate hike just a few weeks ago, but few now see a move in September, and markets only are pricing 17 basis points of hikes over the rest of the year. The bar for another hike in September is now dependent on upward surprises to inflation numbers, at a time when strong disinflationary forces are in play. So the default position is to keep rates constant for a sustained period, said Neil Mehta, portfolio manager at RBC Blue Bay Asset Management. More tightening would, however, be consistent with comments from policymakers, including ECB board member Isabel Schnabel, that raising rates too far would be less costly than not enough. On Wednesday, the U.S. Federal Reserve raised borrowing costs and kept the door open to more rate hikes, though Fed Chair Jerome Powell gave few hints about the September meeting. Indicators of business, investor, and consumer sentiment and bank lending surveys point to a continued deterioration after the Eurozone skirted a recession last winter. And with manufacturing in a deep recession and the previously resilient services sector showing signs of softening despite what is likely to be a superb summer holiday season, it is hard to see where any rebound would come from. Such weakness, exacerbated by a loss of purchasing power after inflation eroded real incomes, could push inflation down faster than some expect, leaving less work for the ECB. We know we are getting closer, Lagarde said, referring to the end of the ECB rate hike run. Do you think there would be an end to the incessant rate hikes? Share your thoughts in the comment section below. Don't forget to like, subscribe, and turn on notifications for future videos. Thanks for watching.